So for 6 months, ever since Trump has been elected, we've been trying to take the tariff risk out of the portfolio without changing any of the underlying composition of the factor sensitivities or giving up the opportunity to be exposed to the really exciting long-term US growth opportunities we see. In practice, that has meant being reasonably underweight industrials, discretionary, and IT, sectors that traditionally have real-world product moving across the border and are most likely to be exposed to tariffs. Of course, the market is really worried about that threat, and you can see that on both the absolute exposure to tariffs and the secondary impacts potentially coming through in the wider economy. It's something that we're going to have to be on top of. It's something that we're going to have to try and navigate in real time. The real problem with this crisis that we're undergoing right now in the market is that it can all change on a day-to-day basis depending on what comes out of the White House. And so it doesn't really make sense to try and make big long-term bets about what's going to happen with the tariff scenario. Instead, I think it is more appropriate to stick to what we're good at, trying to find individual businesses that we invest in for a long, long period of time that are strong and can navigate almost whatever happens in the wider economy. There aren't as many areas that you would see with positive correlation to tariffs as there are with negative. But one area that we've been focused in on quite specifically is around auto insurance. These companies are a small part of consumer budgets, but they're very critical for how people live their lives. And over time, the price that you pay for insurance is very strongly correlated with the cost of cars in the wider market. Now, if auto tariffs go in place in the US, the price of cars will go up, and this will allow and force those insurance companies to raise prices and become more profitable over time. So it's not something that's going to happen extremely quickly, but it will be a consistent tailwind over a number of years that will benefit an area of the market that we already liked anyway. And that's really the framework that we try to use to invest on a positive sense with tariffs, looking for areas that are going to have a persistent tailwind from it, rather than an investment opportunity where the tariff dynamic is the primary reason that you might think it attractive. The fund is mostly exposed on the upside to healthcare and real estate. Both of those you would traditionally expect to find within the traditional dividend fund. But specifically for us, we've tried to be really specific and nuanced about where we allocate our clients' money. So within healthcare, which is a reasonably large overweight on the fund, we don't hold a lot of pharmaceutical companies, for example, because we think that those are particularly exposed to tariffs right now. But we do have a lot of exposure to areas like healthcare insurance and medical technology. This is because those parts of the market are extremely attractive long-term in terms of growth opportunities, and they've also come off a period of time coming into the election last year where the valuations have lagged the rest of the market because people were concerned about what might happen if there was a Democratic sweep in the election. Now that that's not been the case, the stage looks really well set for those companies over the next 3, 4, 5 years to reassert their leadership within the market and trade on fundamentals rather than political headlines. And we think if that's the case, then they're really attractively valued right now. This is probably the first time in maybe 10 to 15 years that the dollar has had a sustained period of weakness. It's very unusual in a historical context for the dollar to be this weak for this amount of time. It's actually provided for the first time a reasonable tailwind to the economy. So a number of businesses are reporting results right now in Q1 reporting season, and many of them are reporting a 2, 3, 4 percentage point tailwind from the fact that the dollar's gone down so much. Overall, the US market isn't anywhere near as sensitive to the dollar as other markets are around the world, but it's a kind of nice offset to some of the tariff pain that we've been seeing for individual companies as well. So the fund doesn't take an explicit bet on the dollar, but we do have sensitivities through the individual companies we hold. And for now, it's been actually a fairly asymmetrical benefit, i.e. if the company is domestic, it doesn't really matter if the dollar's gone down, and if it's selling product overseas, it's a nice little benefit to earnings. The fund, again, doesn't generally tend to take a position based off what a top-down view about market cap. Most of the holdings we will make and the decisions we'll make about investing will be based on individual dynamics of that single investment opportunity. Right now, actually, for the first time in maybe 2 or 3 years, some of the larger cap companies are starting to look a little bit more appropriately valued. So particularly within that wider AI or tech space, the market has been quite severely punishing those businesses year to date. And so we're getting an opportunity maybe in a handful of businesses to move up the market cap scale in some of the holdings we have. But as I said, this is slow and at the margin. It's certainly not the case that we're taking a big top-down view on small cap versus large cap.